class, and welcome to the video lecture for corporations and bonds payable. The first learning unit covers journalizing the issuance of bonds and the payment of interest. First, let's go over some terms used when working with bonds. A bond is just like a note, except its term is longer. Also similar to notes, we have the bond principal, also called the face or par value, an interest rate, and interest payments. Let's look at an example. Joe Rossi owns a $1,000 12% 20-year bond with semi-annual interest payments. This bond was issued to him by Vaughn Corporation. At the end of 20 years, Joe will receive $1,000. In the meantime, every 6 months, which is semi-annual, Joe will receive an interest payment of $60. The interest is calculated as the principal times the rate times time, just as you learned in the chapter covering notes. Let's go over the example in the textbook on page 714. On January 1st, Roger Corporation issued $500,000 worth of bonds with an interest rate of 12%. On the date the corporation issues the bonds, it receives cash from the purchasers of the bonds and records a liability. This is a debit to cash and a credit to bonds payable. At this point, no interest has been paid because no time has passed and no interest expense has yet been incurred. 6 months later, on June 30th, the corporation must begin paying interest to the bondholders. The interest is calculated as the principal, which is $500,000, times the rate, which is 12%, times time in terms of years, which is 6/12 or 1/2. This means the total interest payment is $30,000. The corporation records this as a debit to interest expense and a credit to cash. This interest payment is made every 6 months until the maturity date of the bonds. On the maturity date, the bond is retired. To retire a bond means to pay it off or otherwise remove it from the accounting records. The liability account, bonds payable, is zeroed out with a debit of $500,000 and cash is credited for $500,000. Bonds don't always sell exactly on the interest date. This means only partial interest is recorded. To simplify the payments, bond purchasers who purchase bonds pay the corporation for the portion of interest that has passed. Then, when it's time for the regular interest payment, the corporation pays the bondholder the full amount for 6 months, effectively paying the bondholder back for the interest they paid. Now let's go over the example in the textbook. Roger Corporation records the sale of bonds on March 1st that were issued on January 1st. That means January 1st is the issue date printed on the bond certificate, and interest is paid on June 30th and December 31st every year, regardless of when the bonds are actually sold. In this example, the bonds were actually sold on March 1st. Since 2 months have passed, the bondholders pay the corporation for the face value of the bonds, which is $500,000, plus the interest for the 2 months that has passed. 2 months of interest is $500,000 times 12% times time in terms of years, which is 2/12. That works out to be $10,000. The corporation records the cash received, which is the principal plus the 2 months of interest, $510,000. Then it records a liability, which is bonds payable, for the face value of the bonds, which was $500,000. Then it records an additional liability, which is bond interest payable of $10,000, which represents the liability of the corporation to pay back the bondholders for the interest that they've paid up front. On June 30th, the corporation pays the interest. First, they reduce the liability of interest payable with a debit. Next, they record the interest expense of $20,000. Note that the interest expense is only for 4 months. That's the amount of time that's passed since the bondholders purchased the bonds. Finally, a credit to cash for the full amount of $30,000 is recorded. So that covers Learning Unit 1. In the next Learning Unit, we'll cover bond discounts and premiums.